Welcome back to F.A.C.E. Thank you, Steve Blake.
Thank you.
Mish, great. It's going to be great to hear you. It's been a while.
Yes, I can. Yes, you can hear me, but I'm trying to. Can you hear me?
There, yeah, I can hear you. I can see you. You're
Okay.
on camera.
Oh, great. Yeah,
all right,
I mean,
so
I might as well, right?
yeah, nice setup there. Are these your new digs here?
Yes. Yeah, I mean, if I turn the screen, you can see we have a whole long trading room going on there.
Wow,
And
nice. Yeah.
this is sort of my station, and we love it. We're downtown Santa Fe, right in the heart of things. We actually moved when everybody else was working at home. That's when we decided to take an office, because we had been working from home for a long time, and happy to say market gauge grew. So we needed more space.
Nice. Okay, well, welcome back to F.A.C.E. And I'm not sure if you want to share your screen, or if not, I could move around to different markets.
I actually
the green box.
Screen. Yeah. I kind of put up the here we go.
You talk about the family.
Yeah, we always like to start there because it tells, every picture tells a story, right?
Yes.
So, well, first of all, Dale, hi. How are you?
I'm doing okay, Mish.
Okay.
We're into these summer doldrums, but there is some excitement. And I know one of your major themes that you were real right about was the commodity theme starting, gosh, I don't know, a couple years ago when we were just coming out of a lot of these bases. And recently we've had some corrections just based upon Powell's jawboning.
Exactly.
Really hasn't done anything.
It was talk, not that the Fed talked. They didn't walk, because you can see the bond buying's robust. Junk bonds, if you look there, they actually cleared an 80-month moving average for the first time in, like, I don't know, years, like 2012, 2013. And then you look at the yields, obviously, and they're still low. The TLTs are up, which is suspect, because that makes you wonder why people are buying bonds if everything is so roseate. Right. And even though the Fed is still jawboning, and as of yesterday, we still had some of them talk about tapering sooner than what we expect, they're going to be left with this ultimate dilemma. And that's what we're going to look at here in the Modern Family, because that's why I'm saying it tells a story right here. And I think the Fed is not as out of touch as people think. I think they're just more, really, they're not sure which way they should go at this point. And that's not to say they don't know what they're doing. I just think they're in a precarious spot. So if we look at the charts here and we start with,
they can't reverse now and say, we're not even, they just reversed from we're not even thinking about thinking to what Powell said right last time. So it probably is going to be a cloud hanging over the market until they do something. Maybe it'll be a buy the rumor, sell the fact when the Fed finally does do something.
Well, right. Okay, so with the Fed actually comes in and does something to control inflation. Well, first of all, there's so many things to talk about, so I don't want to sound all scattered. Okay. So let's just go back in history a little bit. And this is what you and I talked about a year ago or more. And of course, I also was talking about stagflation. Yes. And I still think that's where we're heading, not right now, but sometimes what I can do is see really well into the future, but that doesn't necessarily mean anything about market timing. It's just the inevitability of something. But obviously, it could happen in 6 months or maybe even a year. I do know one thing. We are certainly in a commodity inflation cycle. There's no doubt. And that doesn't mean if you get a correction, inflation cycle's over. What people don't really understand, since there hasn't really been focus on commodities in, my goodness,
20 years.
Long time. Yeah. Is that commodities do that. They go parabolic, and then they have these huge corrections, and then they go up again, and they have huge corrections, and up and down and up and down. And it's really takes some kind of a shift in policy to really knock it down and take the wind out of the sails. And here's the perfect example. So if we go back to the mid 1970s, this is what keeps, I've been looking at this now for, again, so long. But in the mid 1970s, you had, of course, reasons. You had the oil embargo, you had the Israeli Six-Day War, and oil prices went crazy. And at the same time, sugar prices went crazy for a couple of reasons. One is sugar obviously is tied to ethanol. Right. And secondly is that in rough times, this has been statistically proven, rough times and in times where things are expensive, people turn to junk food, sugary foods. And of course, sugar is insidious anyway, because it's in everything. But then they really go to it more so, as particularly lower socioeconomic groups. So there's two plays here in sugar. And this is in spite of all of the warnings about how sugar is so terrible for you, yada, yada, yada. Okay. So then what happens? Gold and silver at that time didn't really react very much, nor did any of the grains. But then as we got into the late 70s, as we were turning to the next decade in 1980, we know what happened. Hyperinflation, gold went crazy, silver went crazy, a lot of the grains went crazy. And actually sugar rallied again and had a huge correction, by the way. It rallied again, but not nearly as high as it went back in the mid 70s, because now gold and silver were all the rage.
Was the win buttons, Michelle, whip inflation now in the mid or late 70s? I can't recall. Remember that?
Say the beginning of the
people were wearing buttons that said whip inflation now in the 70s. You remember
oh my
that?
God. Well, I'm going to say no. I don't remember that at
all. I don't remember anything. So, anyway, old timers.
Right, exactly. Oh, was it on Sesame Street? Because that's what I was watching.
Yeah.
Right. Anyway.
But I mean, that was it. Whip inflation now, it'll be something if that was President Ford, Ziggy's saying.
Exactly. Okay, exactly. So we know what happened. I mean, Carter was still president at this point, but the Fed started to raise rates. But what really killed the silver and gold market was the exchange. The exchange came in and not allowed you to buy either metal anymore. You could only sell. And then, of course, you had the bunker hunt problem, and that was the end of that. And it's languished for all these years. And what's so interesting to me, before I get into this, because I think this is, as a student of the market, most people aren't aware of this. And I even tweeted it out this morning. In 1980, the ratio between gold and the Dow was roughly 1-to-1 in terms of price. So here we are 40 years later, and now the Dow is trading at 20 times the value of gold. So we're talking about inflation, and people think, oh, copper went up, steel went up, lumber went up. Of course, it's corrected. Food commodities have gone up, and all of this is true. We must be in an inflationary period. And of course, people will argue and say Bitcoin has taken a lot of the thunder out of gold. But the truth of the matter is now we've got the Basel III starting on Monday as well, which means paper gold is not even considered real gold. You have to have physical gold, which is already in shortage. And if, and I'm not saying this will happen, but if we really do go into a super inflationary cycle, then gold, just think about this. Gold, if it's just going to catch up to where the Dow is now, could be at 15,000. So I just throw that out there because sometimes when you make these outrageous claims, they may or may not come true, but at least it gets people to pay attention to the possibility. So the complacency that we're seeing in the metals and the precious metals right now could either mean that I'm totally wrong and this inflation is transitory and bravo Fed for being right, or it could mean that we're onto something and things are going to get more out of control and spiral out of control in terms of inflation. And we'll really see that reflected in both the gold and silver. That's my spiel for the day.
Okay.
So,
all right. Okay. Was this enough of a pullback to begin reaccumulating?
We were already I think so. I mean, I tweeted out last week that I thought silver bottomed out. It tried to take out the lows on Monday, couldn't stay there, immediately reversed. And I believe it's coming in higher. Yeah, it's coming in higher. And that's with the dollar rising.
Good point.
And the good news that we just got, right, that jobless claims were less than what they expected. They expected, I think it was 390 and it was 364, which is giving a little bit of a boost here to the industrial market, but not really doing so well here. Now the TLTs have come off a little bit because good news means the yields don't have to stay this low.
Maybe some book squaring in front of the NFP.
That too, okay. And long weekend and summer doldrums, as you talked about. But let's switch, because I really think it's important to look at the Modern Family, because people are saying to me, how reliable is the Modern Family? And my answer to them is super reliable. It's never steered me wrong. So let's start here, since we'll go in order. So if we stop here at the top left, this is retail. Of course, Granny of the Modern Family. Those of you who have no idea what I'm talking about, I created this Modern Family mostly for myself to really keep track of macroeconomics using what I consider to be the most important index for the US economy, which is the Russell 2000, because that's all US based companies, manufacturing and industrials. Retail, because obviously we are a consumer economy and it's 70% of the gross domestic product. And then I added computer chips through semiconductors, transportation, which obviously is super important in terms of seeing how goods are moving in the country, regional banks, not big banks, and biotechnology. And I felt this was a really good rounding out. And I'm not going to get into the explanations of cyclical versus non-cyclicals, but this has been super reliable. In the beginning of 2020, NASDAQ was making new highs, S&P 500 was making new highs, and the regional banks were floundering. Transportation was trying to make new highs, it couldn't. The Russell 2000 tried to make new highs, it couldn't. And now here we have
it still can't.
It still can't. So here we are in a very similar situation right here with all of the euphoria that we're seeing and that move that we've seen recently back into mega cap and growth stocks and technology and chip stocks. This is healthy and could go on for a while. Semiconductors could lead the family higher. If you look at it here, now that it's taken out 260, it could go to 300. It could lead the family higher for a while. But generally, what we start to see is either the transportation. If you look at this weekly chart in transportation, not only is it weak, it's a potential bear flag, which means that if we break down next week under this week's lows, we could see another $40 drop in the transportation sector. That's not going to be good. And that's why I'm thinking the stagflation. If you look at the banking sector, of course, it likes the rates being higher. And you can see that this is also, but this was floundering right before COVID happened. And I'm not really sure why regional banks would have been weak, except I'm thinking that people were obviously already starting
risk.
Default risk. And also there was not only default risk, but also if you're looking at what people were doing at the beginning of last year, GDP wasn't moving that much. It wasn't like there was robust housing at that point or robust growth in businesses or job growth. It was good job growth, but it kind of had stagnated. And then retail right here, you can see is trying to get to the new highs, and we'll see if it can get back up to these highs and take it out. And here's back to the Russell, which again is near all-time high, which happened right here in March, but not quite there yet, 234.15. So you put this all together, and biotech, by the way, which was the first one to show us that we were bottoming in March, April of 2020, makes sense because of obviously COVID. There was a lot of research and money being thrown to the pharmaceutical companies for a vaccine. But you put this all together, and what do you see? You see almost a repeat of not just last year, but I could tell you so many times where we were near, whether it was a month off, 2 months or less, a market top is in this scenario when we see this divergence between particularly the inside sectors of the market and then the mega cap and the growth stocks, because ultimately they cannot support the US economy. Yes, we're chip technology and people do go out and buy their new iPhones, and obviously during the COVID, Amazon performed well and all the tech stocks performed well, fell off and now come back. But we need to see what happens here with IYT and KRE and IWM and XRT. And
the old economy.
Exactly. If they can get dragged up, super. If they just stay at a level, okay. But if they start to falter, then I would really start to be not only cautious, but it also may give a clue as to why we're seeing that buying that was going into TLTs, that the surge in jobless claims for the better is good because we're in summer, in fall, in the September, the unemployment benefits stop. Maybe we'll see a little bit more in the surge in the jobs growth, but what's going to create jobs after that? And that's kind of what I think the market is telling us here, particularly in the transportation.
Do you see any regulatory antitrust risk in the FANGs and, in the Facebooks and the Amazons, and, it's a different administration, and Gensler, is head of the SEC, and FINRA came out with the biggest fine for a broker dealer in the history with Robinhood. Do you think, if anyone could screw up a bull market, that it could be our government?
Well, certainly the government is capable of doing anything, obviously, here. But again, let's go back to the antitrust. There has been talk of antitrust investigation and some kind of action for
a long
years.
Time.
Yeah, and nothing's happened. So I don't worry about something until there's something to worry about.
I see.
And as far as Gary Gensler goes, he's got so much on his plate. I mean, he has promised to look into short selling, naked selling. He's promised to look into order flow in terms of commission-free companies that then sell their order flow to dark pools and things like that, into a high-frequency trading. He's promised to look into crypto. He's promised to look into meme stocks. And now he's promising to look into antitrust. Meanwhile, the guy is a Goldman Sachs guy. I mean, I don't know. I'm not sure yet about him, whose side he's on. And the fact that he's going to go after Robinhood, even though Robinhood has definitely done some questionable things, it still attacks the retail investor. And that's what usually happens, is under these investigations that happen, the rules for the mega wealthy do not change. The rules for the regular guy changes.
Oh, they're trying to protect the regular guy.
Oh, yeah. With more regulation. And we know what happens with more regulation.
We have to protect us.
Exactly, because we're getting too smart, so we'll do something wrong. So let's protect them so they can't
protect them from being victorious in the short squeeze.
I mean, really. And what's so great about 2021 is that you've got this whole generation of people who get this and are being very vocal about it. It's sort of an interesting underpinning revolution that's happening here. Like, in our generation, it was, the man versus the people versus the man. Now the people versus the man is more in the financial area, which I think is incredible. But anyway.
And you and I were always taught to fade retail, right? They were the last.
Right. The public is stupid, right, exactly. But the public is. Listen, I'm sure there are going to be plenty of people when the picture changes that are going to be caught by surprise. Yeah. But I also think that this whole meme stock trading is very spontaneous, disorganized. There's no great master plan here. And so if they try to do something to regulate and make that harder, it's going to hurt the whole market, definitely. And so that's what's going on. Anyway, so just to sum up, so I'm watching for a few things. Obviously, I'm watching the dollar. I heard you talk about the dollar. I think the dollar now, if it breaks, if we're looking at DXY, if it breaks down under 92, that could be a little bit of trouble. It's been trying to pop up here.
Are you surprised that it turned before making a new low under 89.20?
No, I'm not, because the momentum was shifting to the positive. So it was showing that the momentum was shifting. You had dollar swaps. When we had that big move down a couple of weeks ago, the Fed came in at the same time they were doing all the jawboning. They actually did dollar swaps, which is a Fed policy where they allow people to swap dollars for debt in foreign countries. That supported the dollar.
I didn't know that.
Yeah, as I heard you mention earlier, maybe if we get a good, strong jobs number tomorrow, you'll see some money going into the dollar. But just because the dollar worked off some oversold conditions doesn't mean that I'm necessarily bullish in the dollar. I'm just not ready to get bearish again. But I do believe that the dollar longer term has real issues between digital currency and cryptocurrency.
Yeah,
So
I see you're covering crypto much more recently. I've seen some of your stuff, and gosh, your coverage. I hope you're still getting to get some rest every day with everything that you're covering.
Today is particularly insane because when I get off with you guys, I'm doing Cheddar Opening Bell, then I'm doing Cavuto, Fox Business, and then I've got Boom Bust I do every week with Russian TV of all things. It's good. It's good. This is a good type of exhaustion because it means that people want to hear from an experienced trader, and these networks have me on constantly because I have a perspective that's different than economists or people who work for large banks and corporations who may run major hedge funds and can't really even talk as freely as they would like, perhaps. I have no gumption about being totally honest, forthright, and because I have real trading experience, or what they call push the button, all of a sudden I've been in high demand. So I'm good with that. I'm good.
All right. One of our viewers is asking, can you explain swapping dollars for debt quickly, Michele?
Well, basically, because we are the largest holder of our own debt here in the United States, but other countries, foreign countries, also hold U.S. debt. And so what happens in a situation where the Fed might come in, and they did this during the pandemic too, is they allow foreign countries to swap their dollars for debt. So basically that's the skinny on it. Do I know every single nuance of it? No, I mean, I'm not going to profess to be some kind of an expert in dollar swaps, but I do know that it's something that the Fed can use to manipulate the price of the dollar and also to help foreign countries with their U.S. debt.
Okay.
That's about as far as my knowledge goes. I hope that's helpful.
And as far as yields, I'm having a tough time getting a handle on it. U.S. dollar yen, it's been sharply higher, almost looks like a breakout. To me, that would imply higher yields, even though it's a very mixed picture on the 10-year. Are you leaning that way?
Yeah, well, I think the yield curve has started to come in again, right? Let me just put up the TLT here for a second. So yeah, I mean, what's interesting about the TLT was the same kind of thing. In fact, if you look at this chart right here, this is the monthly chart. And the monthly chart, this 80-month moving average, and I'm going to show you it in junk. We broke down under it briefly in 2018. And then at the end of 2018, if you recall, there was an announcement that they might taper, and then the market went, taper tantrum. And then the Fed said, oh, no, never mind. And since then, obviously, you can see we had the big collapse of the bonds after all the stimulus. But now it never broke this level right here. So the fact that it's bouncing, to me, is probably okay. But can it get through 150? Probably not. That's what I'm looking at. So, yeah. And then if we look at the junk bonds, this to me is the most interesting.
Yeah, HYG.
And I don't know, it's coming in. It looks like it's going to come in lower because it's 920 bid at 969, which means we could be leaving maybe a little bit of a top here. And this is so important to watch because this is going to tell you, forget about what the Fed says.
Yeah.
My best tip today, really, if you're really interested in knowing what the Fed does, is watch these. And you can watch HYG, same kind of thing. I just happen to like JNK for some reason, I guess because it's so literal, junk. But you can see it made a new high here, a new multi-year high. And at the same time, this 80-month moving average, I'm going to blow this up. This has been trading underneath it, if we can kind of project, since 2013, 2014, and we broke out of it in recent months. So this is really where you're seeing what I like to call the Fed folly. However, we did have a little bit of a higher move for 110.33 back in January right before the big dump. So we had a big move up in junk bonds as the market was going up, and then boom, COVID happened, and that was the end of that.
Will this really lead or follow any kind of significant or intermediate, to me, this is a leader. Top leader?
It's a secret leader. It's a secret leader. Most people don't even think about it, let alone. But I was last year was looking at this going, wait, what's wrong? This just made a new high and now it's starting to tank. And I remember very clearly saying that if this broke a certain level, I don't remember what it was, but that it was time to be cautious. And now here we are again, mirror image. We made a new certainly yearly high, and certainly over the last few months. Yeah, look, we haven't been there in a while. And now we're coming in lower. We got a decent jobless claims situation. And also the inflation narrative hasn't really gone away. So here you go. Keep your eye here. If this thing actually looks like it's going to have some kind of a sharp reversal, then that would also make me cautious, because that would mean the end also for the growth stocks. I mean, they're enjoying the low yields right now.
Exactly. All right. Well, Michele, another great interview, and you keep getting better and better. And, I really appreciate your generous spirit by giving us time and edifying our community. Best way for people to follow you and get involved with you, you want to show your site, and I know your Twitter handle is @MarketMinute. And
let me show. Oh, I think I just completely. Let me see if I can get into a.
You could do a new share.
Yeah, I'm going to do a new share, but first let me get to the right screen. Hold on.
Okay. What's the weather like there today in Santa Fe?
Well, we've had this incredible amount of. No, we had a heat wave, and then we had a tremendous amount of rain.
Oh.
So that's and now so that's really cooled things down.
Nice.
So let me see if I can show you. So here is our market gauge site, and I'm going to go back here and share the screen so you can see it.
Okay.
Here we go. Here's my market gauge site. There's me. There's my book, Plant Your Money Tree. We do have every week, we do a lot of writing. There's a daily blog and then a weekly one that Keith does. We now added a whole crypto section. And then also, if you want to find me on Twitter, that's @MarketMinute. That's probably where I'm the most active.
Yeah, and you are. And
yes.
Yes, and Paul's saying that he loves the RSI 3 settings.
Oh, yes. We can talk about that next time.
Okay, we will. And that's a great segue for saying thank you, my trading warrior sister, for being here today. Congratulations on the growth at your company, and you and your whole crew and your husband and all the people that listen to you. And it does, I talk to people and they'll say Mish said this and Mish said that, and a lot of respect from here and in the FinTwit community. Michele, thank you very much.
Thank you. I've worked hard to earn that respect, so I appreciate that.
You deserve it. You deserve it. Go ahead.
Well, I was just going to say thank you, Dale, because you and I have been friends for a long time now.
Yeah, I appreciate what the wisdom that you have. The Bible calls wisdom she.
Yeah, well, I'm not surprised.
All right. Thank you, Michele.
On that note.
Yeah, good hunting. There's a confident woman who's not surprised that wisdom comes from our wives and the women in our lives. So keep that in mind, and thank you, Michele.
Okay. You take care. Thank you, everybody. Bye-bye.
Right. Remember, everyone, that's a wrap. Don't just count your pips, count your blessings. We'll see everyone for the NFP Live tomorrow, and thank you again, Michele Schneider. Adios.